Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. So today we have FuturesTrader71. I believe this is his fourth time on BMT. If you have not checked out the prior 3 webinars, then I definitely encourage you to do so. They're fantastic webinars filled with a lot of really great information. Today, his webinar title is Putting All the Pieces Together. So more or less, we're going to review a lot of the things that were talked about in the prior webinars and kind of, an overall picture of how you're supposed to put all these things together and make yourself a profitable trader. As you guys have questions, type them into the chat box, and FT71 or Anthony will do the best he can to answer everyone's questions. The recording for the webinar will be posted on BMT sometime tomorrow. It's bigmiketrading.com. Click on webinars from the top of any page, and you'll see a link sometime tomorrow when I have a chance to put it up there. Okay, guys, hang on 1 second, and I'll turn things over to FT.
All right, let's see. Can you see that?
Yes, we've got the video and audio.
Am I on? All right. So let's get started. So first of all, thanks for having me on, Mike, again. I certainly appreciate being able to share ideas, and hopefully the ultimate goal here is to influence at least one person, if that, into changing the way they look at things. So that's really what this is all about for me. Let's look at what we have today. Mike asked me what topic I thought would be interesting to cover today. I had done 3 webinars for Big Mike Trading, and I thought, maybe take a pause here and put things together, and that's what the title of this is. What I'm trying to do is basically take the pieces that I've laid out in prior webinars, and the link, the forum page where the link for the webinar is, has the links under a posting Mike put on that shows you the prior webinars. Okay, so putting the pieces together. If you don't know me, my online name is FuturesTrader71. Been at this for 12 years, and I've trained and traded with my own traders as a prop shop owner for about 8 of those years, and I've gone through a lot of traders and a lot of psychological and all kinds of issues with traders, and I'm aware of what I don't know everything. I'll never say I'll know everything, and I'm constantly learning, as everybody should be. But I do have a pretty good idea of what stands in the way of consistency. That's, as always, I have to start off with the risk disclosure. You have to know that derivative transactions, including futures, are complex and carry a risk of substantial losses and are not suited for all investors. The information I'm sharing here in this presentation is for educational purposes only. It is not intended for use as trading or investment advice. So use at your own risk. Let's start with risk, and hopefully you won't get vertigo with this presentation style. But let's look at risk. Okay, what we're going to do is take all the 4 big pieces, 4 big chunks of trading, which are risk management, risk assessment, the homework and methodology, your mindset or psychology, and then the execution and the tools. Okay, so that's basically what we're covering here in the time allotted Should be about an hour or so. So let's start with risk. First, we have to put together risk capital. And under risk capital, we have how much capitalization do you have, and then within that, you have to look at, what assets and savings do you have, what living expenses do you have to consider in the equation, and then part of the capitalization issue is also the attachment to money, which ties in with your mindset. It's all great that you have a $100,000 account, but if you're someone who has a hard time getting past a loss of $100, then that $100,000 account isn't doing you any good. So that's part of the process. And if the $100,000 is money that you need to pay for your children's college education and your day-to-day expenses, then that's not good either, because this money that you're going to trade with is at risk, and in fact you can lose more than this money, more than that amount, because of leverage in futures. Now, I know not everyone here trades futures. I've traded stocks. In fact, I started with stocks. You do get a certain amount of leverage with most brokers. I think it's between 2 to 4 margin to cash. So there's, even there is a risk of losing your entire account, if not more than that. Okay, so capitalization is part of the risk equation. The other part is understanding risk and leverage, which is what I talked about. This is the second presentation I did. I talked about risk and leverage, and within risk you have to be able to identify and understand what type of risk are you taking, and generally there are two types for the type of work that we're involved in. There's information risk and price risk. Information risk is when you take prices and take the price that you want and risk not knowing enough about what's going to happen next. Price risk is when you wait for more information and risk a worse price in order to get that information or confirmation, or like an indicator crossing over or something like that. Those are the two main types of risk. I prefer to take information risk. I prefer to take a better price and wait for the market to unfold than to take price risk by waiting for it to make a higher low to get long or something like that. I want to be in early, and I want to manage my risk with size, or manage my risk with by trading multiple contracts. The second part of risk that you have to understand is thinking in probabilities. It's very important to come into this just like an athlete does when they enter into a professional competition or competitive sport of any kind. You come in understanding your strengths and playing the probabilities. That's what you want. You want to be able to, essentially what your trading is going to be about is trying to pull an edge out of the product that you're going to trade, the time frame you're going to trade it in, and then extrapolating as much information out of that as possible. And we'll talk about homework and research in a minute. And then just playing that probability over and over and over, as over time in a very large data set or in a large data set, that probability, I'm not going to say should, but is likely to reveal itself. You might get 4 stops in a row before that the streak turns for you. It might not, but you're trading probabilities. You're not trading from the perspective of I know this is going to happen. This is the hardest part for people to, for most traders who are struggling with consistency, to understand, is that you're trading a probability. And in trading a probability, you automatically accept that you're likely to be wrong. There's a certain percent or whatever that you're going to be wrong. And so all you can do is take the trade that gives you a favorable edge or a favorable probability, all the while knowing that the outcome for that particular trade is not known. So what can you do in that situation? All you can do in that situation is manage your risk, because that's the only thing that stands in the way of your ability to take the next trade or blowing up your account, so that you never, the edge never materializes, okay? I might have lost a few of you there, I'm not sure, but this is what it is. What is an edge? Is an edge, you know, knowing that 62.38% of the time, if A, B, C happen, then D is going to happen. You can state that. But for me, an edge is much simpler, because I'm just a dumb old trader, right? I'm not a PhD quant or an analyst or one of these amazing predictors that show up on CNBC all the time. I'm just a trader. I'm trading a small time frame. So the edge for me is just the chance of one thing occurring over another. That's it. So I just want to know that this particular thing, given what has just happened, given the context, that this particular thing is likely to occur over another. Okay, and that's enough for me to go ahead and take that trade. And when I do take the trade, I'm sizing it according to what I feel or have researched to be the probability of that edge showing up. Again, I'm going to re-emphasize that for this particular trade that I just took, let's say, I do not know the outcome. The outcome is unknowable. And as long as the outcome is unknowable, the only weapon I have, and the weapon of choice, is just what we're discussing here, risk management. Understanding the risk involved and using leverage to my advantage. When I feel like there's something really coming together for me, then I'll push the gas. If not, then I'll play it light and tight. And I don't recommend that for somebody who's just starting out or somebody who's not consistent yet. We're going to talk a little bit about execution later on. There's a step that comes in before that, but for now, just think in probabilities. It doesn't matter who you paid for the system that you got, you know, your signals from. It doesn't matter how much homework you did. It doesn't matter how perfect your homework is. The fact is, you're trading a probability. You've got to let go of being right, okay? And managing risk is the element, or is that part of your business as a trader that allows you to continue to trade and figure this out. If you don't have risk under control, it is going to be very hard to survive your learning curve, and your learning curve is an expensive process, just like your college tuition is, just like it is for any other job. Okay, and then the other part of understanding your risk is understanding your product. Now, in stocks, there are several things you have to know. Most people just go in and trade. Oh, you know, I want to trade Facebook today, so you just hop in and trade Facebook, or Hot, or Google, or Apple, or whatever. But you have to understand your product. You have to understand earnings. You have to understand what's coming out. When is Apple announcing the next product? Is there something going on with Apple? Are they taking someone over? What dates? Is there a split coming? All these things you have to understand. So it is not, I would not suggest to those people who are having a hard time with consistency to end up trading across many products. They feel like, ooh, this guy is making money hand over fist trading whatever, name a stock like Johnson & Johnson today or something, and then you switch to J&J, and then this guy's doing great trading Google, so you switch to Google. This guy's doing great. Don't do that. Understand your product. Until you have consistency, you have not attained the level of skill that would allow you to jump around. Same in futures. If you're going to trade the S&P minis, trade the S&P minis. Stick with them. Understand the tick size, rollover dates, understand expiration when it comes, understand the economic releases that affect it. When does it close? What is the margin requirement to open a position? What is it to maintain a position? Understand how many ticks you have for the day, how much credit you have for the day before you have to stop because of your daily loss limit. Part of the issue is folks will either trade too many things or they'll trade in too many ways. And in either case, in either side, they introduce randomness. And in fact, with most starting traders or inconsistent traders, they are trading randomness to the power of 5 because they're changing products consistently. That's one. They're changing methodology consistently. That's 2. They are discretionary in their entry, so that could be random. That's 3. They are managing the trade randomly, so once they get in there, they're, one day they have a 2-point stop, the next day they have a point stop, which they extend, and then they have a 1-point scale, which they extend or, take a 2-tick profit. It's just random. And then the 5th random point is the time of day. One day they're trading 7:20 till 9:30. The next day they come in at 9:15 and trade till 12. And then the day after that they're down on the day, so they trade from 5 a.m. to 4 p.m. And so those are all random things, and the product behaves differently. So the S&P trades differently than the Russell. Your setup is going to change depending on context, and for me that's a random. It's not random, but it's a changing metric. The entry is a changing thing because I'm a discretionary trader. I don't trade a system. And these other things you have to limit, especially trade execution. Once the trade's been executed, you need to stick with it. So I'll talk about that a little bit later. The next portion about this, with regards to risk, is risk management. Are you sizing your position properly? Let's zoom in a little bit here. Are you sizing your position properly? Have you set your loss limits? That's supposed to say loss, not lost. Have you set your loss limit for the day? Do you obey that loss limit? The daily loss limit. Do you actually stop? Do you have the discipline and the resolve to pull yourself away while you're down? Sometimes in a boxing match, the other guy is just too big, too strong. It's much better to just stay down, so that you can come back, you can train some more, you can come back and fight another day. Only Rocky gets up after getting his face smashed in and still win, and we know how realistic that is. It's one thing to be persistent. It's another thing to be stupidly persistent to the point that you eat through 30, 40, 50% of your account just because you think it's okay to fight back. There's nothing to fight back in the market. It's just you, your psychology, your ideas, and the big wave that the market is and the wave that you're trying to surf. You're not going to get very far surfing against the waves down in Costa Rica or Hawaii. It's not going to work for you too well. It's just too big. The market's too big for you to fight. And then the final thing with risk management is accepting the risk, and that's part of the process. Just one second. So that's risk. That's one piece of the puzzle. The next, homework. One sec. The next is homework. So all right, hang on. I'm trying to make this work. So is this good enough? So the other portion is homework. That's the other piece. Homework and methodology. the first part of your homework that matters is to be in a structured learning environment. What does that mean? Part of what Big Mike Trading does, obviously, is to provide an environment through the journals and having a study group type of setting. Generally, you need to exercise discipline and not getting caught up in various discussions that are not very fruitful or whatever. But you need a structured learning environment, just like you had in school or in college. Studying or learning randomly, it just prolongs your process. So you need a structured learning environment, and that's one of the things that I've worked on with Anthony for our clients, is to provide an environment where it is safe for you to ask questions and then to point you to the resources you need to have in order to get the answers that you need, with the objective that you will have the pieces together, you'll do your own work and come up with intelligent questions and an intelligent approach. The next thing you need is a comfortable approach. So I use volume profiling. You see a little graphic of it down here. This is a volume profile of the Russell. You can see the volume profile here, delta and so forth. This is my methodology. It does not mean that that's what you should use, but it's what works for me. So find a comfortable approach. If you're comfortable with using stochastics, CCIs, RSIs, whatever, it doesn't matter, geometry, Elliott, and so on. If it rings true to you, it's almost like finding a comfortable approach is like finding a religion that makes sense to you. It's a very personal thing. There is no right or wrong. I tend to try to cut things down to very simple pieces until folks master themselves or get better at controlling themselves, and then you can throw complexity into the equation. The more stuff you have on your screen, the more of a learning curve, the more it extends your learning curve. The more you simplify things, the easier it is for you to execute and see through what needs to happen. And generally, because of our education and the way we're taught growing up, we generally believe, and we truly believe, that more is better. More lines, more averages, more this, more that is better. And it's not, because it creates conflict. Now, putting more on to do homework is fine, but for execution, it has to be simple. Pick 3 elements that you're going to trade off of and practice to trade off of them on the one product you're going to trade on at the same time you're going to trade every day. Okay? So pick 3 things that you're going to become a master at. You're going to be the super master of the CCI indicator, using stochastics, or whatever you want to use, volume profile. Become the master of it. Do it at the same time every day. Watch it, trade it, and this will help you become much, much better at what you're trying to do. So most of us are okay with finding a structured learning environment and finding an approach. Only some of us make a focused effort, okay? So our effort is more about being random, about trading in the middle of the range, about just putting something on. Man, I haven't put a trade on for a long time, so I'm just going to trade right here, where it doesn't make any sense. Make a focused effort, because you know what, as it shows on the right here, and there's a book about this, it's called Talent is Overrated. And talent is overrated. I don't believe it or not, and I did a lot of sports growing up, talent is not something you're born with. There's an aptitude to certain things, like certain things will make more sense to you than others. A game of chess might be something you pick up quickly because it meshes with the way your mind works. And we think, wow, that guy's got talent. He learned chess in one sitting. But actually, talent is focused effort. It's a commitment, it's discipline, and a focused effort. And if you want to read up on that, read Talent is Overrated. Another great book that talks about this is Tipping Point by Malcolm Gladwell and many others. Millman. You can go to my website and look at the resources section under books, and I have some listed. You really want to come into this with the idea. Now, if you're serious about making this into a career, you want to come into this with the idea that, you know what, I don't have time to waste. I'm going to focus my effort on getting this done. Only some will get to that point. Even fewer, it's a small circle, it says monitored results. Even fewer than that will actually monitor their results. And if you were a professional player and had a coach, that coach is monitoring your progress. They're monitoring your statistics. They're monitoring everything that you're doing, and it creates a feedback loop to help you figure out if your focused effort is going towards the right, towards the right elements that help you along with your trading. The website is www.FuturesTrader71.com. I'll post it at the end. The next piece is a trader's mindset, and this is a vast sea right here, because this is almost everybody's weakest link. If you are able to have a lot of capital to trade with, if you are able to focus on one system and do it consistently, the thing that is most likely to get you next is your own psychology, your own fear and greed is going to get in the way of progress. The emotional response that is created when we have something at risk, like a 300-pound person running at you with a fist, creates an emotional response. It creates a fight or flight response. I'm not a psychologist. I know this through experience and through others. The body doesn't know the difference between a 300-pound person with a fist coming for you to punch your lights out, or a trade that is going against you 4 points and is risking 30% of your account. It just doesn't, it can't decipher the difference. And so what it'll do is, when you put that trade on, and if you're not aware of your quote-unquote monkey, it's what I call it, if you're not aware of it, if you're not accepting that it's there and that it's pretty powerful, your monkey is that thing that causes you to move your stop, that causes you to take a 2-tick winner and a 3-point loss. That's your monkey. Your body, the part of your brain that controls this response, is it's still programmed in an ancient way. It does not care if it's a physical threat or a financial threat or an emotional threat. It treats them all the same. It's either going to fight or it's going to run. So if you kept a good journal and look at the trades you put on and how you manage them, you'll find that you're either a runner or a fighter, given the circumstance. And everybody has both elements within them. You're a fighter if you're risk-seeking, which means that you have a little bit of credit yet. You still have some cushion in your account to lean on, or you've had a streak of wins in the prior days that made you overconfident, and so you become risk-seeking. But if you have been beaten down quite a bit, you become risk-averse. The same person will become risk-averse, and they'll start to take 2-tick winners and just avoid taking the loss and hoping and praying that it comes back. And the market doesn't care. Really the only way to control that, or to affect a positive change in that environment, is to just be mechanical. Be mechanical about your trade management. So your entries are discretionary, so that you're not trading a trading system. You're looking at context, you're looking at how the market traded, but once the trade gets put on, you need to just let it trade out. You need to either let it hit your stop or get your targets or whatever and just move on to the next trade. The sooner you move on to the next trade, the better your chances are of realizing the edge that you're trying to trade. It is when you hold on to that horrible trade that you are destroying not only the equity in your account, but any chance that you would catch that trade that could redeem the day. Don't try to control it. Just be comfortable trading with it, screaming to go against your plan. And that's what happens. You get in, and all kinds of stuff starts happening in your head, and you just cannot let the trade play out. Don't use the monkey as an excuse. Don't sit there and say, oh man, it's that monkey inside that caused me to close it. No, you're in control. You are responsible for your trades. Believe that you're worth the success that you're seeking. Many people feel that, this sounds like frou-frou, but it's true. Many people will sabotage their success because they feel like, it's too, it's not for me, it's too good to be true. Don't sabotage your success. Just believe that you'll get what you have coming. You will in this lifetime. So just let it be. It's give it your best shot. If it works, it works. If it doesn't, you know what you're standing to lose. You know what you have at risk, and let it play out. Okay? Whether it's a trade, whether it's trading as a career, whether it's a relationship, a business venture, a trip, a hike, it doesn't matter. You've got to believe that you're going to enjoy the process. You're in the process. You're not sitting here trading and dreaming of the $300,000 days ahead. You're just taking it one trade, one moment at a time. Be present while you trade. This is probably not going to make any sense to a lot of people, but it's an important component of you having a high quality of life, is to just be here now. Just be in the moment. Enjoy the process while it's happening, and to be aware of what's going on inside while you're trading or playing or spending time with family or whatever. Just it's an important part of your health as a trader and a human being. Believe in your plan and that the edge will show up in your trading. So you've done all this homework, so let it play out. Visualize your trading plan homework before the market opens. I go through my homework every day. I tweet it out when I can. I go over it with our clients before the open. But I also imagine how it's going to look like. I imagine what the market's going to do. And when the market opens and it does something different than what I had imagined, that's a clue to me. That provides me with a clue. I imagine the area that it's going to come to that I want to trade at. I imagine how it's going to fill me. And obviously this takes experience in watching the market for a while to be able to imagine that. But anybody who's spent, maybe 3 months in front of a trading environment is going to have that. I visualize how it's going to happen, and I just let it play out. Either it stops me out or I take the trade. I visualize the trade working. I visualize the trade working, and I let the risk take care of itself. Okay? Don't think when the trade is on. This is so key, and I'll cover it again in the execution portion of this. Don't think when the trade is on. Does that make sense? Most of you are probably going, You're thinking, you're planning, you're contemplating, you're looking up, you're researching, has to be done before the trade is on. Okay? What I often say is you don't get any smarter once you put the trade on. If I took a survey of everyone in the room, I bet you that most of you believe that you get smarter once the trade is on. What do I mean by that? You wanted to get long. Today, I was monitoring 17. I was monitoring 14, 12. Those were key areas for the day. And I know that once it gets to that area, once I get in, I can't sit there and go, gee, what could go wrong? Let me look up my homework. Let me look at the 60-minute and see what could go against it. Let me look. It's too late. It's too late. That's homework time. Homework time is when you are supposed to do all that, gain the confidence. 300th in line to 1500th in line, and it might touch that price trade 300 and never fill you your price, or they move their stop. Why did you? How is it that you got smarter after putting the trade on that you would move your stop? Oh yeah, oh my God, I should put my stop below the low. Well, you shouldn't have taken the trade then. It's too late. Let it play out. The stop placement, the target placement, the scale out placement is something that you preferably have thought out and tried to put on your side as far as an edge before you put the trade on. So messing with those parameters after the trade is on is a lot like trying to tune your controls for your fighter jet, tweak the controls of your fighter jet while you're, flying at high speeds towards your enemy. It's not smart. Okay, so don't think when a trade is on, simply execute. It is too late to think and plan. In most cases, you will not get smarter once the trade is on. Just remember that. The other one is take your losses. Don't try to be right. A loss taken quickly brings you closer to a trade that works. Bank your losses. That's what the coin flip exercise is about. It shows you that you might have a 5 or 6 losing streak, but in the cards or in the next trades, you could have a 5 or 6 winning streak just as well. The probability of one happening, if the other happens, are balanced. Okay, assuming you're trading some sort of an edge. And so take the loss, move on. This business is not about how many hours you spend in front of the screen. Again, I'm going to repeat that. This business is not about how many hours you spend in front of the screen. It's about how many trades you take. And you can't take more and more trades to gain the experience necessary to move your approach to trading from the logical mind, from your left brain, to the intuitive mind, which is our goal. Our goal is to move our trading almost thoughtless to an almost thoughtless state. The best traders I know. And when I'm trading in the flow, I'm not thinking too much. It's intuitive. It's quite intuitive, because the intuitive mind is able to put things together much more quickly and relate to much more vast amounts of information than the logical mind. The logical mind tends to trip up. It's a lot like what happens when you practice saying something in your head versus saying it out loud when you're giving a speech to people. It's a lot more complicated and jarred to speak out loud. So take your losses. The more trades you take, assuming that you have your risk under control and you are taking your stops, the more you move towards gaining the experience necessary and the number of trades necessary for you to start seeing through the market and being able to be comfortable putting on that next trade even though you've taken a loss after a loss after a loss. Your edge shows up, you take it. Your edge shows up, you take it. And then a lot of this is covered in Webinar 3 again on the website, so I won't go over it again. Obey your limits. Your mindset is going to change very drastically if you exceed your limits for the day and continue to trade, or if you do something that you've told yourself you didn't want to do, because you will lose confidence in yourself, and in turn will have a very hard time putting on that next trade because you've lost confidence in the most basic thing, and that is your ability to follow your plan. So the last part of this is execution and tools. Let's start with execution. Involves a plan. What will you do? Know where to trade. Know what your risk is for that particular trade, for that particular setup. Know that probabilities favor your context. Does it matter if your stop is 2 points or 2.5 points or 6 ticks or 5 ticks? Yes, it does, but what matters more is your patience and your ability to execute at the location you designated as your area to trade. Make sure if you're scaling out, make sure your scale out distance or the number of ticks to the scale out or the price to scale out is balanced with your stop. If you're going long and there's a resistance level that's, you know, $1 away, but your stop is $2 away, that trade is not very well thought out. It may have a hard time getting through that resistance, and it may find it a lot easier to get your stop. So know what your risk is, know where to trade, and then once the trade is executed, let it play out. Let the whole trade play out. Know that probabilities favor your context. So only trade when you know that the probabilities favor your context. So, for example, it opened, it had a very strong push up on the open. It has very weak pullbacks or counter rotations, and it keeps making higher highs and so on. Know that the context here is a trend day, and that, you know, you're taking a breakout on a trend day might be profitable, but it also puts you far away from where you would stop out. So know the context, know the probability of taking that breakout. Again, you don't need to know it to the 1/100%, but you just need to know that the probabilities favor what you're trying to do. Let the trade go once it is on. Again, I'm going to emphasize this. It's like a bullet. Once you fire it, you can't bend it, you can't change it, you can't call it back. Let it go. You can always click and get out, which is what most people do. Oh my God, this doesn't look good. It keeps going, you know, 4 ticks my way, then it keeps coming to scratch. So you know what? I'm going to take a 2-tick win and just call it good. Well, you're not obeying you're not being disciplined. So let the trade play out. Let it get your target or your stop. Book it, journal it, study it later, let it play out. Messing or micromanaging your trades is probably one of the most difficult things to correct, because if your entries are discretionary and your trade management or trade execution is random, then it'll be very hard for you to figure out, is it my setups that have stopped working, or am I messing with the trades so much that that could be the problem? If I'm taking discretionary setups and I'm managing the trade discretionarily, then what do I change? Which one is wrong? So you need an anchor point, much like a surveyor needs a benchmark to measure everything else by. And for me personally, the benchmark is how I execute the trade, how I let the trade play out. I always look for a scale, a certain number of ticks from entry, and then I take my second scale a certain number of ticks away, and then the rest is discretionary. And I measure the performance of the trade by how those scales, the mechanical scales, happened. Okay, so if this trade you have a 1.5 stop or 6-tick stop, and in the next trade you decide to expand it to 3 points, and then the trade after that it's only 4. When your plan is not working, it's going to be very, very difficult for you to figure out, is the setup no longer working in the context of the market, or is it that I'm messing around with the trade execution so much that I'm not able to let the trades play out. Would the trades have played out had I left it alone? So I suggest you do that. That's what a simulator is great for, because with a simulator you can set a wide stop, set a wide target, and look at how does the market behave at the entry, and let it play out. And then we have a tool which Anthony's going to talk about in a little bit, called the Trade Analyzer, that tells you how much a heat did you take in a trade, how much did it go in your favor, and you can use those statistics then to figure out what is an appropriate stop and so forth. There are many of you obviously who program and backtest, and that's another way to find out. But if you trade discretionarily, it's very difficult to program how the trade would have played out. I know that for a fact because I tried it so many times. The next piece is to execute. Plan, aim, and fire. Let the trade play out its course. Don't micromanage the trade if it is done according to your homework. One thing I didn't mention here, be patient. Don't try to anticipate the trade. Don't try to get it done. If it comes to your area and it moves away quickly, just relax. It's just one trade. There will be another and another and another, so just relax. Don't try to anticipate the trade and try to front run it, because then again it puts you that close, it puts you that close to the market hitting your stop if you're anticipating and front running the trade, especially if you have a tight stop like 6 ticks or 4 ticks. You're not smarter just because you're in the market. We discussed this earlier. You can't see the market for what it is as long as you have funds at risk. Again, that's your monkey. As long as there's something at risk, it'll be very hard for you to be objective. I don't care who you are. You have to go through a whole heck of a lot of trades and gain the experience to be able to remain objective while there's risk on the table. Okay? And then the last part, I just want Anthony to go over it here.
Yeah, can you hear me?
Yes. So everybody, this is Anthony Giacomin. He's the head broker here. He deals with data feeds and all the different trading platforms and tools that we have. So just say hi to Anthony. He's going to talk to you for a minute.
Perfect. Thank you very much, and pleasure to be here, guys. You know, as FT is going through all of the criteria for putting the pieces together, what it takes to become a trader from A to Z, making the turn, as he so often puts it, and what is needed to really have a full package, a full, complete solution. One of the things that comes into play is the brokerage side of the game. So he constantly speaks about the emotional side of the game, the statistical side of the game, the probability side of the game, and what it takes for the trade side of the game. But then you also will always need to have the tool side, the setup, the trading structure. And FT and I have worked together for many years. We've known each other since it's been about 2004 when I was his account rep at Eurex for his prop shop. So we've always worked on this path of providing people with the best tools possible. And one of the things that constantly comes up is what does it mean to me as the individual, as the trader, and that's why we wanted to kind of address this and have me jump on and just discuss the tool side of the game, the system side of the game, the software side of the game, rather than just have FT keep going and do the brokerage part, which is not his expertise. His expertise is the trading, the education, the trader management, the statistical probability, the homework, where my expertise comes into play for the software and what's needed from an end user's point of view. And it's kind of, there's kind of a lot of factors when you take a step back and you start looking at what works best for you, the individual. There's certain aspects that you really need to consider. You know, we put on here trading on a stable platform, and it's very, very important. There are a lot of stable platforms out there, but there's also a lot of platforms out there that are marketed heavily, that people think are great platforms, but in reality they go down, they freeze. You know, they're free, and there's a lot of ways that you can cut down your costs on your platforms. A lot of platforms are free. But you need to make sure whatever platform you're using that it is reliable, that it is stable, that it isn't going down when there's a big influx of market data or some volatility in the marketplace, especially with these markets slow as they are now. When volatility really starts picking up, it's a real problem to have your platform freeze up, skip, or shut down, and you have to either log out and log back in on your platform, or even you'll have to shut your entire machine down. And that brings us to another point. Oshio Functionality, if you trade with like bracket orders or orders that will cancel once you get filled, if you send an order cancels other order out to the marketplace, you'll have one profit target and you'll have one stop loss, for example. If your computer or if your system goes down and you lose connectivity, you have the profit target in the marketplace and you have your stop loss in the marketplace, but you've lost the functionality to cancel the other side because it resides on your machine. So if your platform's not stable and it goes down all the time, well, then that functionality is not going to be stable either. There are some platforms out there that allow you to have that Oshio functionality on the server side. You know, we're blessed enough to offer pretty much any platform that you're looking for. We're not platform specific. We understand that each user has his own specific set of criteria that he needs, whether it's NinjaTrader, CQG, CTS, the VK Trader, which is a white-labeled OEC platform. We've started with the VK Trader and the OEC platform to build the VK Trade Analyzer off of it. Now that's a risk management, trade management tool that I'll go into in a bit. But whether it's any platform that you're really looking for, we think it's very important that you find what you need for your criteria. It doesn't matter if someone's trying to sell you on a platform that doesn't make sense to you. If it makes sense to you, you're going to have less errors, you're going to have less clicks and less growing pains as you know the software as part of your tools. And as your tools, it's your weapon that you go into battle with. And you need to understand that weapon inside and out. And that's why it's important that you feel comfortable with the platform that you're using to trade with. Getting into the VK Trade Analyzer, that's a piece of software that we started to develop with the VK Trader. That software goes through your intraday, intratrade statistics, and it gives you a running total of how you're trading for that session. Now, it's important for us and for our clients to use this because it allows them to manage their risk on a daily intratrade basis. A lot of times you have a lot of software packages out there and a lot of analytical tools out there that allow you to take past historical data and review that and see what your MFE is, your MAE, your total risk on the day, and the way your performance statistics measure up. But with the VK Trade Analyzer, we've taken it one step further. Actually, we haven't. FT has. FT has developed this thing from scratch with his own personal knowledge, which is it's really quite amazing. This takes your intraday statistics, your intratrade statistics, and tells you how you're doing on your trade with your MFE, your current live trade with your MFE and MAE on that live trade. It will give you an overview as to where you can better kind of trim certain areas of your trading plan, of your game. You may be taking too much heat. You may be letting your losers run and cutting your winners short. Well, this gives you a visual description as to that, and it does it daily. So it kind of gives you an idea as to where you're moving and how you can better get there with your own trading. Another thing that FT had mentioned earlier in this presentation that I'd like to bring attention to is he mentioned the stop loss, a daily stop loss. Oh, thanks, good. He was showing the trade analyzer. Yeah, so this is the trade analyzer. Anyways, it goes through your daily statistics. You see your overall position, your what your total MFE is, your MAE, your best scale out as you're in your trade. Let's see here. Can you go to the chart?
Yeah, don't forget the theoretical average, which is what I use the most to control my position. Essentially, because I took profits for 9 ticks on this particular trade, my average has moved in my favor from 13.12 to 13.09 quarters. So now I would have to exit at 13.09 quarter to scratch the trade. You wanted the chart?
Yeah, please. So this is what I was talking about when you can kind of gives yourself a visual graphical tool to see how you're doing on those trades on a trade-per-trade basis. You can see where the black numbers is your actual profited gain or loss. Your running P&L is the blue line. Your MFE and your MAE are the areas that you had your trade in your favor and had the trade against you. You know, at the 140 ticks versus the 280 ticks, it's a fair ratio. But if that was 140 ticks negative and 70 ticks of your MFE, then you would know that you would be trading on a ratio that's not, on a risk-reward ratio that's probably not going to be beneficial to you in the long run. A 2-to-1 risk-to-reward ratio means that you would be risking 2 ticks for every 1 tick that you would gain, and that would not be something that you would want to be, well, that I would want to be trading with in the long run. Unless you had firm statistics behind it and a study behind it. But yeah, this is a trade analyzer. It's really amazing. Actually, he made one for his prop shop back in '05, and we were trying to pull it out of the woodworks this last weekend to get it going with one of our buddies who's writing a book about high frequency trading, and just basically the functionality of that older trade analyzer and where we have this one, that thing is beautiful, but the functionality of this trade analyzer and the smoothness of the application is just, it's really nice to have, and we look forward to the continued development of it. You saw that it's just getting started, but it gives you the statistics, you know, that are really important to you for now. Let's see here. If you wanted to just pop back on that screen, Morad.
What's that?
If you want to just change it to back to the slide.
Oh, okay. All right.
Okay, so data. Before we get into data, wanted to make sure that we talked about loss limit. He mentions it all the time. We mention it constantly. It's very, very important. You want to have either a broker that can help you provide a hard limit loss limit that says if you lose X amount of dollars on a given day that you can't trade anymore, or you want to make sure that you have your software being able to have that functionality built into it. This is a big area of importance to us. A lot of platforms out there have that functionality. Some test out the server side of that functionality where it's hard-coded. It depends on the product that you're trading, whether the hard-coded stop is the right fit for you or not. Because if it's a wide marketplace, you don't have the ability to, what can happen is you can have a bad tick, hit your loss limit, and you can get risked out of your trade. So the hard limit loss limit is good in certain circumstances and bad in certain circumstances where a fast market, a moving market can give you a bad tick which can risk you out. Whereas the software-based risk management tools allow you to keep an eye on it, monitor it, set up systems where you can get liquidated. You can have your position exited. You can put alerts up. These are very important tools to have because even though you're in control, even though you know that you're only risking $500 per day in your daily loss, we think it's in your best interest to have some sort of protection mechanism there for you, to alert you, to remind you, hey, I hit this number. I need to stop. You know, what did FT mention earlier, that sometimes it's best to, if you're getting punched in the face by a big monster that you can't beat, to go back, lay down, stay down, and come back and fight again. Go back to your studies. Come back. That's why the loss limit, whatever it is, if it's on the system, if it's on an alert that pops up, if it liquidates you, is very, very important. From there, and like we were saying, multiple platforms have different ways of handling this. Definitely worth talking to your broker, finding out how they actually handle that. So we have it in multiple scenarios here, so it kind of depends on your unique situation. Get the best data you can afford. Poor data equals low confidence and homework. Okay, very important. A lot of times you can end up getting free data from your broker. That free data is always going to be in real-time data, which is very good because it's free, but you're most likely going to want to supplement that with a historical data feed. Depending on the software package that you're using, you can get historical data feeds for different costs. We really like DTN as an overall data company, a data service provider. They have great real-time data. They have great historical data. What's nice about DTN is they have a historical data feed called the DTN Market Access Feed that you can get with Market Delta Trader or Market Delta Charts or Investor RT. If you're not part of that grandfather package, which happened sometime like in the late 1990s, you can get this historical data feed through Kinetic or DTN IQ feed, which is the real-time and historical data feed. The reason why it's so important is because you're just getting the cleanest of data and ticks for your studies. So that's one where you're having costs for your data. Costs vary based on broker, and costs vary based on platform. In certain circumstances, we give our clients real-time data, for example, for their Investor RT charts, their Market Delta charts, their NinjaTrader charts, their Sierra charts. Sierra charts actually has a pretty decent historical data server of their own that they provide historical data for, so they're kind of good. You do have to do adjusted data. You would have to adjust the data with them, where the DTN IQ feed and the DTN Market Access historical data feed would provide you with the adjusted continuous data. So depending on the service, depending on the software that you're looking at, you'd be able to have the real-time data feed with some sort of historical backfill. Again, when it comes to paying for the live data, you have the ability to lower your costs of that live data by having your broker who's a partner with the CME and the DTN IQ feed for exchange fee waivers. So you can have the DTN IQ feed without having to pay for the exchange fee data with a broker partner. Pretty good way to lower your overall overhead. Again, we tend to think that there's multiple steps to this. First step, free real-time data. Second step is free real-time data with the historical data feed, backfill feed, and then the third step is paying for your free real-time data, or paying for your real-time data with that historical backfill feed. And then you can lower your costs of the DTN IQ feed, which is the real-time and the backfill, by having a broker that works with DTN and the CME to offer exchange fee waivers. Another one is pretty nice, which is keep your trading computer lean. I mean, a lot of times when you're working with multiple software packages like we are, we're actually very lucky to not have that many computer-related issues. But a lot of times when we do, and when someone is having problems, it's because they have 1,000 things running. The client has 1,000 things running on their machine. They're running a webinar. They're running a chart. They're running every product available within their trading platform on their charts at one time. And all of this is just fighting for the same resources as what you're trying to do with your execution. And as we discussed, your execution is you with your tools, with your weapons, going to battle for you, yourself, and no one else. Just you and yourself. And you're going up against professionals, and you're going up against machines and algorithms, and the second you put an order in, you're putting your order in to fight with everyone. So it's very important to keep your machine lean. We always discuss having a charting machine and having an execution machine, and that way your order is not fighting to get to the exchange with a webinar and 18 charts running. So that's definitely one of the areas that we would recommend if possible. If not, there's ways to cut down on it. Have only one chart up. Have the chart up that you're watching. Maybe keep your resources down by only watching a webinar when you're not trading. When you're not viewing, when a product doesn't matter to you, don't keep it up on your quote board. Don't keep it up as a chart. It doesn't matter to you. Why are you allowing that data to affect the overall resources of your machine? Have your broker info in hand. Yeah, when we have a new client come in, and this is really important, we put this on the account activation email, but most people don't really check it until they do have a problem. But on the email that we send out, it's basically a piece of paper that if you print, you can fold it in half, and it says, okay, here's the important information to me. My account number, my username. Doesn't have password because that's protected. It has the phone number to reach the 24-hour help desk. It has the steps to walk through if you're going to need to call someone to get out of a trade. That information is extremely valuable for you. No matter what, have it written down, have it by your computer. In case something happens, you need to call and get out of a trade, your computer goes down, you lose connectivity, you need that information right away.
If I can jump in here, Anthony, this is one of the most important things when it comes to risk, because you can't control what happens with your connection. You can't control the fact that some contractor just ripped through a bank of fiber optic that took down your connection. So what I've done for years is to take that email like Anthony sends, or maybe a piece of paper, and you write this stuff down, your account number, the account name, your username, the 24-hour hotline to your trade desk so you can get out. I take it and I fold it lengthwise so that normally you'd fold a paper in half widthwise. I fold it lengthwise, and it sits under my trading computer's keyboard. It fits right under the keyboard. You don't see it, but you know it's there. In addition to that, you always want to have a charged cell phone handy. If your DSL goes down, chances are your phone has gone down. Most people don't even have, a lot of people don't have phone lines. They run off of the internet, Magic Jack, and so on. So you need some other source so you can call your trade desk immediately and have them cancel all your orders that are sitting out there, or to work you out of a position or whatever. So make sure you take the time, even tonight, to get that information together, fold it in half, stick it under your keyboard so that you know exactly what you need to know when you need to call your broker, especially the clearing firm's trade desk, to get you out of a trade. It's very important.
Yeah, absolutely. And then the other thing real quick is that it's really important to know that your orders are going direct to the market, that you have direct connect data, direct connect platform. If you enter a stop order on the market, it's sitting on the market, it's residing on the market's actual exchange servers. You don't want anything to be held on your side. You want everything to be held on the market as much as possible. So stop orders, limit orders, anything that goes in as a unique order, as a unique individual order, one stop, one limit, one market that's going direct to the exchange servers and residing directly on the exchange. Now, FT, I wasn't sure if you wanted to run through getting a solid connection, or if you just wanted to hurry this up. And I know I've been on for a while.
The last thing about a solid connection is I want those folks who are still here to know that exchanges are designed to burst at 10 megabits per second per exchange. And the CME is actually pushing 20 megabits per second. So trying to pull your data and connect to your Skype with your chat group and trying to trade all through a 1.5 megabit per second DSL line, which your girlfriend is surfing YouTube on in the other room or whatever, or you're pulling your, whoa, are you okay? Or you're pulling your TV from or whatever, it's not a very wise business decision. Most folks, I suggest most folks go to 6 megs if they can. Generally on DSL, that's on the high end. Most DSL providers can't go above that. Cable is better. The problem with cable is that it's a shared bandwidth, which means that you could get 20 megabits per second today, but if everybody in your neighborhood's hooked up and is watching a rerun of The Sopranos or something on the internet or YouTube, you're sharing that connection and it increases your latency. So getting a solid connection, I mean, imagine if you're out there, you've got a solid trading platform, you've got good charts, good everything, you've done your homework, everything's great, but you're trading on a 700 kilobit per second line, you know, you'll feel it. You'll feel that it takes 1 or 2 seconds from the time you click until the exchange or the platform confirms that trade for you, and that's going to take away from your confidence. So having a solid connection is an important factor. If through some of my when I used to talk a lot online, I used to say 2 connections, but I know that that's not realistic for a lot of folks, so I won't recommend that. But usually I trade on DSL, and I pull all of my data and auxiliary information through cable. Here at the office at Vancar, we have a 100 megabit microwave line, which takes care of all of that. But I do suggest that you keep you keep your bandwidth high, and if possible, have some sort of a backup. At a minimum, you want to have your broker or clearing firm data available immediately, so that if you lose a connection or if your platform goes down, you're able to call the right number right away instead of fidgeting around while the market's moving. Remember, your connection will most likely fail when there's a burst. And when there's a burst, that means there's a lot of volatility in the market and your platform's not able to keep up. Now, knock on wood, I mean, I trade on the VK Trader platform now, and it has not gone down for me for as long as I've had it up. So I've been able to cancel my paid, the other paid platforms that I used to use. But at the time when a platform goes down, generally there's a lot of movement, and if there's a lot of movement, that's when your connection is going to get tested or go down, and that's when having that information handy is most important, because the movement happens because volatility increases, volume increases, so all of your trades are at risk, or your orders are at risk in the market. So let's finish up here. Let's go back to our nifty little slide thing.
And FT, just so you know, I've got a lot of questions that I've been setting on, so hopefully we have time to get to them.
Yeah, okay, I'll keep 15 minutes for that if that's okay. We're pretty much done with this material I wanted to cover. This was meant to be a head-to-toe look at what it takes to put it together. If you have questions, you can get on my website. It's right there, www.FuturesTrader71.com. It's really not much more than a community service website, and you can hit the contact button and get a hold of me. If not, I suggest you go to the resources page and go through, and I discuss a lot of this. In the past, you can go to one of the most useful things under resources to go to the chat log, and you can see all these chats that I've done that cover not only the methodology, but a lot of the questions that have come up repeatedly that I've decided to just go ahead and do a talk on live impromptu or whatever. But there's the other part is the blog. If you go to the blog section and you scroll down to my earlier blogs when I first started to go out into the public, it covers, you know, the software, the trading methodology, what I'm talking about, and I suggest you go through that before you ask questions if you can. If you have questions, go ahead and fire away, and hopefully we'll have these people get back to their families or whatever.
So while we're waiting for any questions to come in from the audience, I have a few of my own. So these are just random. What are your thoughts on showing the profit and loss in dollars, ticks, or percentages on your DOM during the day?
I feel very strongly about not having money come into the equation. I know that you know, one of the things I like about this platform I'm using now is that I don't need to look at, you know, I'm able to hide my P&L. My P&L, my decisions to trade are based on market context and what the market is doing. They have nothing to do with how much money I'm up or down. I have a general sense based on the trades that I've taken, whether I got stopped out or if I got a target. I have a general sense of what position I'm in for the day. In other words, you know, am I up well, am I down? But to sit there and measure your performance trade by trade based on your P&L is doing you more harm than good. Now, if you're a trader that's already consistent, you're just rocking it, you're probably not listening to me, for one thing. You're probably not here, and having the dollars don't matter. But the fact that you're taking the next trade and the amount of risk that you will take versus the amount of gain you want to have for that trade, having that be based on your P&L is just it's more ruin than good. A lot of people have lost their day trying to chase that last $25.
Let me ask about, I know that you're a fan of establishing a daily loss limit. Let me ask you the reverse side about a daily profit target. Some people view it as, you know, a bad thing that you would limit your upside. What do you think?
I used to think that it was a bad thing, but I don't anymore. I think that most folks don't recognize the importance and the tremendous benefit of putting a string of up days together. It boosts your emotional capital so much that you actually become much more proficient at getting into the zone with the market. So my answer would be, if you have been beat up a little bit, you're probably better off setting an upside target and taking trades the same way you would if you hadn't set that target. But after a few trades, and if you feel you've attained it, check your P&L, pull it up, put it away. If you've hit your target, it's good to stop, switch to sim, or stop and do research or whatever for the rest of the day, right, to build that gain, to build that equity, because it really changes the way you look at the market. So
what about practicing patience? My question is, we all know that, I think, well, my opinion is that where a lot of people fail is in lacking patience, and they enter trades in areas that don't make any sense, and then they have trouble making that trade profitable because of their entry. So the question is, do you think that it is fruitful for someone to look at multiple markets in order to, in a way, practice patience, you know, so they don't get bored because they're looking at more than one market and they're waiting for a particular area of interest to happen in each individual market? Or do you think that that's going to cause more problems than it solves?
I would be on the side of, and this is just my opinion, I would be on the side of looking at your market and changing the time frame than at looking at multiple markets. Here's the reason. Looking at a different market presents all kinds of challenges. Like if you normally trade the Russell and you're not getting your setup, so you decide to look at crude, you're introducing so many factors that affect crude but don't affect the Russell. Or even if it's a Russell versus Dow, there are elements of the Dow that are unique to the Dow but don't exist in the Russell, given that it's a small cap that's got 2,000 stocks in it. For me, I would advocate more, since you're kind of getting in tune with that product and how it moves. When is it behaving normally? When is it behaving abnormally? It's better for you to just switch your time frame and find more setups as part of your homework, obviously not while you're trading, but in preparation, than it is to start looking at 2-3 products. And the worst thing is when somebody's trading the S&P but is trading it off of the NQ, or trading it off the Dow. Oh, the Dow's hitting a major level here. Let me get short the S&P. That could spin you out of control. It's better to just, you know, I've been through this a lot. It's better to just pick a product and just stay with it, and then change the time frame, find setups. I mean, you could find setups in a 300-tick chart, you know, and generate, you know, 200 setups a day if you want. So, you know, you can adjust the time frame.
Okay, now on this next question, you spend a lot of time answering it, but okay, the question is placing a trade, and then some people say you should like walk out of the room. You know, if you have trouble managing the trade, or you have trouble exiting the trade, or not leaving it on, or not letting, you know, the outcome play itself out, leave the room. Some people say that that doesn't make sense because you need to be managing the trade. You need to see if the market is doing something that you did not expect it to do, if there's some type of new information that's coming in. And I know you spoke heavily on this, but I think it's worth mentioning one more time what you think about that, and the advantages or disadvantages of putting a trade on and you're either going to get stopped or you're going to have a target at the end, or managing the trade only from the point of view of something has happened, or you think it has happened, right, while you're in the trade that you did not notice beforehand.
I'm going to...
The perception is key, right? The trick is, has something really happened, or
yes,
do you just think it has happened?
And that's the thing. That's where I pull in the analogy of the tipsy driver leaving the party and promising everyone that he knows he's fine to drive and everything is cool, and then he gets into the car and then drives too fast and wraps his car around the telephone pole or something. You know, you cannot, unless, again, the context of this question has to be put in the form of what stage of experience do you have? Are you in stage 1, 2, 3, or 4? And generally, for someone who's inconsistent, you are better off planning the trade with fixed outcomes, with a fixed scale and a fixed target and a fixed stop, and just letting it play out in general. And there's nothing wrong with just doing this on sim until you're perfectly comfortable with it. And it's better to do that than to sit there and think and actually believe that you can actively manage a trade when you're actually trading from fear. Because you know what? For every line or piece of information that says this trade will work, I can sit behind you, whisper in your ear things that'll convince you that it isn't going to work. Okay, and you don't need me to do that. You can do that perfectly fine on your own. And so what I've done actually during rough patches is to put the trade on, turn away, like my trading platforms to the left, the monitor for my trading platforms to the left. And I just look at that as an order entry tool, and I just turn to the chart. I turn to the chart and I assess it based on the information I used to enter the trade. Has something changed in the profile that says that this trade is doomed? The only time I would actively manage a trade and not let it hit my stop is if it travels to a target or to a level of resistance, I don't get filled and it comes all the way back. It's telling me, I chose that target for a reason, and it's telling me that there isn't the participation that I wanted. Otherwise, I'm going to take my scale. I always take a fixed scale. I take my scale and I let it stop me out. And in general, my stop is reduced a lot because the scale pays for the stop in most cases. And it allows me to take the next trade. But to think that you can actually actively manage a trade while you're in it and you're not consistent, you're trading out of fear, is an illusion.
Right. I was hoping that you could show an actual chart. I don't know if you have your charts available, and talk more specifically for just a minute about information risk versus price risk, because I think this is a really, really important thing for someone to understand, and I think it might be easier to understand by actually looking at a real trade example on a chart, and you could describe, you know, the upside or downside of information risk versus price risk.
Okay, so today, what you see in gray here, these lines in gray, these are my homework areas. So from the open, it opened at 20, this dotted green line. From the open, I had 19, which comes from the bigger term chart, this black line. This is the most traded price since the 17th when the market went into balance. I had 19. I had 17, which comes from yesterday's or Friday's profile. I had 14 and a half. I had 12. I had 9 1/4 and 8 1/2. And the first trade I took today was a test of, was it 12 or 14? No, it was 14. And let me switch to the chart I look at while I'm trading in the morning, which is a 2500 volume. So, so the first level I had was 17. It came down to 17 half, which was the opening swing. Tried to push back through to the open, could not. Started to see weakness. Then I took the trade right here. 14 half is the gap fill, this dashed orange line. Took this trade up to the midpoint was the area that I was concerned about, which was 17 half, which is the first low it put in. So I actually got filled on the 17 because I was sitting there for a long time. I got filled on the 17, and when it came back, I ended up closing this trade out. So with regards to information versus price risk, when it came down to this 14 half, I'm there. I know that I'm going to trade. The question I'm dealing with is where exactly. And I think in the last webinar I showed you, I did for Big Mike, I showed my trading platform and how I look at absorption, how I'm looking at the dome. And it's a very hard thing to describe fluidly because it's a thing where you just can see it by gaining experience, much like, you know, if your mom's a really good cook, she doesn't measure how much salt she puts on. She just puts it on and the dish comes out perfect every time. It's just experience. And so for me, I knew that I was going to do this trade at 14 half, period. When I saw it stall, I don't really care if it puts in a lower high or a higher low. I don't care. I'm going to get in as close to 14 half as I can and let the market play out. And in most cases, I can get my scale. And as long as I can get my scale, most, not all, but most of my risk comes off the table. And that's all I'm interested in. My first priority is to take risk off the table.
Well,
and so if I, go ahead.
So, I mean, in the last webinar, this is you stalking the trade, and I understand all that. So tell us what, you know, what you would do if you were not using information risk, but you were using price risk, or vice versa. What would the decision process, how would it change?
Okay, if I was taking price risk, is that what you're asking? As opposed to information risk? Do you know the difference? Yes. Information risk is essentially taking a better price at the cost of not knowing what's going to happen next, which we really never know.
Right.
Versus price risk where I'm waiting for confirmation, but entering at a worse price.
Right.
So
So I'm saying like a lot of, okay, maybe I rephrase this or phrased it wrong. You once said confirmation is for Catholics, and a lot of people like that.
it's true.
That plays into what we're talking about in my point of view, because a lot of people have this theory that they will not take a trade until they get confirmation. But the question is, like, in my eye, confirmation is kind of, it depends on what you think confirmation is, right? Is confirmation a higher low or lower high? Is confirmation, the absorption of a certain price level on the DOM, and that's giving you confidence to enter the trade? I'm trying to distinguish the difference between how much confirmation is enough confirmation versus too much, and now you've taken the wrong kind of risk.
Yeah, it's a great question, and the answer is the same as what I just said. How much salt is too much when you're just pinching it out of the container and sprinkling it on your wonderful grilled steak or whatever. It's something you kind of gain with time. The issue with confirmation, the most obvious issue with confirmation, is waiting for the counter rotation. Let's say you're fading a move down like I was doing this morning. I'm fading a move down back into value, and the confirmation problem that I see is that folks will wait for a lot of movement and a lot of hesitation in order to step in and take the trade. If I had stepped in, let's say with a 6-tick stop, okay? If I had stepped in on the pullback, it went from 14.50 to 16. Then it went 14.75, so higher by a tick, and it starts to take out the 16, and I get in at 16.25. Well, now my stop is at 14.75 at 6 ticks, and it's not that hard for the market to come and take that out. I don't want to wait that long. I want my stop to be well below the most recent price action. Definitely not within the first couple of ticks below the most recent low, which is where the sucker stops are. You notice it just takes out the stop by 2 ticks or 3 ticks, and it turns right around and goes, and you're sitting there going, why? How do they know where my stop is? They don't know. It's just that's where most people are going to put their stop. So for me, how much information is enough? The key element that I don't want to get lost here, the key element is that I know that I'm going to trade at that level. I just know it. What I'm doing, though, by looking at the DOM and absorption and stuff, is nothing more than trying to refine that entry. How critical is that? It really is not that critical. I can accept a wider stop, size my position smaller, or even trade a 1-lot, let's say, and use a wider stop and just let it play out. The outcome is likely to be the same than sitting there refining my stop at the level and then getting in once I see, oh, this is stalling, it's unable to punch through, I'm going to get long. I'm going to lift the market, a tick or two above the low, the stall price, and getting in. But the confirmation that generally people wait for is an 8 moving average crossing a 20 or something like that.
Right.
For it to do that, it has to close so many times at higher prices in order for that average to pull up. I'm interested in where price is and where volume is, period. So I'm not waiting for too much information.
Right. So the last, and I see a lot of people, if it's not a moving average, then it's something else. It's an oscillator that needs to cross the 0 line, or some indicator has to be red instead of green or whatever, right, before they can take a trade. My last question. So, now that you have the brokerage, I was wondering if you could name, like, I don't know, 3 or 4 things, from your high-level view. You're way up there. You're looking down over a whole bunch of people. What 3 or 4 things separates winners from losers? Their actions and their trades. What are they doing differently?
Actions and trades, or in general?
Yeah, I mean, what are they doing differently that's causing the winner to win and the loser to lose?
One of the key elements, well, other than the usual culprits like undercapitalization and so forth, is the key element that is killing people by 1,000 cuts is not obeying their losses, not obeying their stop loss. I've got, again, what we do best here is try to help people not blow themselves up. And it really pains me to see a person risking 30% of their account because they just cannot take the loss. It's very hard. It's not guaranteed and it's not bulletproof, but it is very hard to lose a large chunk of your account or to blow up before you can make the turn if you have a reasonable stop loss or risk plan in place. And that includes things like a stop loss per trade, a way to stop from trading in the same direction consistently all day long, and a daily stop loss. If you can obey, and that I try to demonstrate that with coin flips and those clients that have a hard time or are hitting a bad streak, I almost always send them the instructions for coin flips and then go through the results and go through their conclusions. And almost always the conclusion is, oh my God, if I had just let the trade stop out and just take the next setup, over time I do okay. My setups are not that bad. The problem is most people lose so much that they never actually realize that or get to that point. That is your greatest culprit right there. It's disrespect for risk. And then the other main culprit, and we have several people that have struggled for years and are on the cusp of making the turn and are very active in the chat room and so forth, and trade openly in the chat room. The other thing is just micromanaging the trade. Once you put the trade on, it's like a bullet. Once it's fired, you kind of you need to let it play out. Micromanaging trades is this impulse, this fight or flight response where you think that you can get a better outcome by messing with your targets and stops while you've got the trade on. It's too late to do that. That's the other main culprit. The third main thing is homework. Folks just do not do their homework. They just want to follow somebody in and out of trades. They're not simplifying the process. They're not keeping it simple enough. And I cover that in Webinar 4 to try to keep the homework exercises down. You can just wait for the market to come to your area and understand why you outline that area. Is it going to stop there? Who knows? But at least you're performing your trades at areas that have a decent chance. And by the way, I want to outline something. The results of coin tosses, the win rate on coin tosses in general is somewhere between 30 and 40% win rate. The fourth stage of a coin toss, I have people take the trades at their areas to do homework, to do business, and generally their win rate is worse than a coin flip. I'm sure that's going to start a whole long discussion on your board, but it's the truth.
Yeah.
Most people flipping a coin and following some risk management or trade management mechanically outperform the trades that they've taken live before I stopped them and told them that they need to do this. A lot of people are down at the 20 to 30% rate, and the coin flip consistently gets 30 to 40%. A coin flip is beating their live trades.
Let me ask two things. One is you got a big following. Okay, so I think that you are in a prime position to answer this question, and it's a serious question because I deal with this all the time. Let me ask you straight up. The people that insist on only trying to copy someone else, okay, even after you tell them, like you, for example, yourself, someone that is got this methodology and you have a lot of followers, yet you're the first person to say, don't copy me. If these people are only interested in copying and that's all they do, they focus all their attention on trying to find someone to copy. The question is there any hope for these people, or should they simply not trade?
It's a competitive process. It's a competitive sport. So the problem with copying things, and a lot of the stuff I've shared over the last couple of years has been copied and reproduced and sold for higher prices and so forth. The problem with that is you're always at the mercy of the originator. You're always at the mercy of that person's homework. The moment of truth comes when you put the trade on. And if you haven't done the work and the come up with the idea of the trade, it's going to be very hard to keep your monkey tame. I mean, your monkey turns into a gorilla in that situation. So let's say you decided to put up your live trading screen and take trades live for everybody to follow. Most of the time, and I would probably bet a hefty amount that you will outperform everybody who's following you in and out of the trade, because most people will not play the trade through the way you would, having done the homework and having gained the experience by doing the homework yourself. So following people into trades is a lot like trying to be a surgeon while you cheat off of someone's test results
right.
and board exam. The moment of truth comes in when you're actually performing the work. Then everything, all your weaknesses will show up.
Right.
So it's not a winning strategy.
It was one of the turtle traders, and I can't remember his name, but I think he has a famous quote that he said that he could put the exact entries and exits, he could print them in the Wall Street Journal, and still no one would take the advice, just because everyone thinks they can do it better than the original.
Yeah, it's Richard Dennis, the guy who actually started the whole turtle thing. He said he could write out his entire trading plan, and most people will probably fail to make money at it. And that's the absolute truth. And that's why I don't talk about setups. I don't post setups. I've stopped posting trades. It doesn't help anyone. It just creates an ego trip for the person posting and a match for everybody else. It doesn't help.
All right. So last question: where can someone get the coin toss instructions? Is it something that you give out, or is it something that you want to, exchange some emails to help the person? How does it work?
It's something that I've offered out to clients. It's proprietary. I've been considering, because it's so effective, I've been considering creating a webinar for it and putting it on the site for free. I might end up having to do that, and I know a lot of people need it really badly. But I'll put something out soon. I generally am kind of controlling. I'm trying to help people control their risk, and that's the whole purpose of the brokerage, being with Vancar. But I need to look at creating a video for that and putting it out there for those people who need the help, including the spreadsheets needed to keep track of it and so forth. Now, one of the key things with the coin toss is the trade analyzer, because you need to look at your MAE, MFE, and the statistics within the trade, and the trade analyzer keeps track of that on a tick-by-tick, real-time basis. But there could be a watered-down version that could still be okay to use that I can put out.
Okay, so I think that's probably a good ending point. If you can throw up some contact information, and anybody that has any further questions, what's the best way for them to reach you? If they want to get this coin toss, what should they do? How should they get a hold of you or Anthony?
The best place to get a hold of me is on the website, FuturesTrader71.com, and then obviously for any information regarding the trading platform, homework, and so forth, just go to Vancar, VANKAR.com, and you can look at all the different trading platforms that we support and all the tools, and obviously ask for a demo so they can test it out for themselves. It's all available on the website, again, Vancar.com. I appreciate you having me on. I hope this was useful to everyone in attendance, and I look forward to this discussion this is going to create over the next couple of days.
All right, thanks, FT, absolutely, and I look forward to having you back for our 3-year anniversary. We've got a lot of big guys coming for our BMT 3-year anniversary. Happy to have you as part of that. So I'll put the recording for this webinar up on BMT sometime tomorrow. Everyone can find it in the usual place, and I will send it to FT as well, and he'll send it out to you guys. All right, guys, hope everyone has a good week.
Thanks a lot.
Thanks. Bye.
Take care.